Welcome to the Rational Edge.
Today, we are doing a deep dive into something absolutely critical to every single business. It's a company's greatest asset, but it can also be its most devastating vulnerability. We're talking about cash.
Right. The sources call it the ultimate paradox. I mean, how can
Yeah.
the most liquid, most essential asset, the very oxygen of an enterprise, also be the thing that sinks so many businesses?
Well, its superpower is also its danger. Cash gives you maximum liquidity, which means you can turn it into anything else instantly.
And it's universally accepted. You can't pay your suppliers with, unsold inventory.
Exactly. But cash always works. And because it always works, it's also the easiest thing to steal.
The easiest to misappropriate and the hardest to trace once it's gone. The sources were clear that a cash flow break will kill a profitable business faster than anything else.
That's it. Profit on the books is one thing, but cash in the bank, that dictates whether you survive today.
So, our mission for this deep dive is to really analyze this dual nature of cash. We'll look at the strategies for managing it, and I think most importantly, the internal controls, the corporate immune system that are designed to protect it.
Okay, so let's start with a basic definition.
hmm
When you see cash and cash equivalents on a financial statement, that's a lot more than just uh, the bills in a register.
Right, so what's in that main cash bucket?
Cash in accounting terms is anything that's ready to go. So funds in your bank account, customer checks you've just received, cashier's checks, money orders, stuff you can deposit and use immediately.
And then there's the other part, cash equivalents. I loved the analogy in the source material for this. They called them the corporate frozen dumplings.
Huh, that's a perfect way to put it. Something you can turn into a meal, or in this case, money, with almost no effort.
So these are short-term, highly liquid investments.
Yes, think treasury bills or money market funds that are due in, say, less than 3 months. The key is they can be converted to a known amount of cash, and there's, an insignificant risk that their value will change.
That certainty is everything. And for you as a listener, understanding that distinction is vital. You need to know how much capital is truly liquid right now versus how much is just waiting to be thawed out.
And companies have to disclose their policy on this. They have to be consistent.
Okay, that brings us to the art of managing all this. The treasurer's job sounds, well, kind of impossible.
But it's a balancing act. The goals sound simple. 1, plan your cash coming in so you can meet all your payments going out. 2, keep only the bare minimum of cash you need on hand.
Why is too much cash a bad thing? That seems strange. More cash, more safety? No.
It feels that way, but cash that's just sitting in a checking account is earning zero return. It's an unproductive asset. You're losing money to inflation every day.
So you're losing out on what that money could be doing.
Exactly. It's an opportunity cost. So you get these really sharp, almost counterintuitive strategies to manage the cash cycle.
Like getting your customers to pay you faster.
Right. Encourage collection of receivables. Maybe you offer a small discount, say 2%, if they pay in 10 days instead of the usual 30.
And then the really tricky part is doing the opposite with your own bills.
The flip side, delaying the payment of your liabilities. If a supplier gives you 30 days to pay, you use their money for as long as you can. You manage your process to pay on day 29 or 30.
But that sounds so risky. I mean, aren't you damaging your relationship with that supplier? Or risking late fees?
You absolutely are if you mess it up. That's why it's an art form. You go right up to the line, the contractual line, but you never, ever cross it. It's smart tactics, not bad faith.
Beyond just timing payments, what else can a company do?
It's about not tying up cash unnecessarily. For example, do you really need to own that warehouse? Or could you just lease it?
So you avoid the huge cash outlay of buying it.
Exactly. Renting or leasing assets keeps your cash flexible. And for those big purchases you have to make, like new machinery, you plan them. You time them for when your cash flow is naturally at its strongest.
And any cash left over after all that, the excess.
You put it to work. Idle cash is a wasted resource. You either invest it back into the business for growth, or you put it into those safe, short-term cash equivalents we were talking about.
Okay, so we've got this finely tuned system. Now let's talk about the dark side, the threats. What are the enemies that the internal controls are built to fight?
We can break them down into 3 levels. First, you have simple misappropriation.
Just basic theft.
Yeah, an employee pockets some money from the cash register. It's a problem, but it's usually isolated.
Okay, what's next?
Next is error. This is unintentional. A typo in data entry, a math mistake. The books don't match reality, but nobody was trying to be malicious.
But the big one, the real monster, is fraud.
Fraud is the devastating one. It's not a simple mistake. It's systemic deception. It's using the company's own rules against itself. Think fake invoices, shell companies, all designed to bleed money out.
And the case study on procurement fraud was just a perfect example of that.
It's a classic. This manager sets up his own fake company, a shell company, and he uses it to sell basic office supplies, ink, and paperback to his own firm at insane prices.
And nobody noticed because, I mean, who questions an invoice for printer paper? It's the perfect cover.
What made it work, and this is the key lesson, was the concentration of duties. He was the one who could order the supplies.
Okay.
He was the one who signed off that the goods were received.
No.
And he was the one who approved the invoice for payment. It was the entire chain.
A one-man transaction. It's unbelievable. And it was only caught by accident, right? Some new accountant just thought the sheer volume of printer ink seemed off.
That's right. And that failure of process, that's what brings us to the defense system, internal controls. And the goal here isn't to catch bad people. It's to design a process where it's just really, really hard to do bad things.
And the core principle behind all of it is something called segregation of duties, SOD.
In plain English, the person touching the money should never be the person keeping the records,
And vice versa.
and vice versa. No single person should control a transaction from start to finish. You have to separate authorization, custody of the asset, and the recording of it.
The coffee shop lesson from the sources really drives this home.
Oh, it's perfect. So imagine you have this one trusted manager at a coffee shop, and they do everything. They collect the cash from customers, that's custody.
Right.
They count the register at night, and crucially, they also have access to the accounting system to alter the day's sales records.
They control all three parts. So what can they do?
They can take, say, $50 in cash out of the register. Then they prepare the bank deposit slip for the lower amount. Then they go into the computer and just delete the sales records for those last few coffees.
So the cash, the deposit slip, and the company's books all match the fake number. The theft is invisible.
Completely invisible. But if you segregate those duties, if the cashier can't access the accounting software and a different person verifies the register tape against the physical cash, the whole scheme falls apart.
It's a structural fix.
Yeah.
And beyond just separating tasks between people, we can use the bank itself as a kind of independent witness.
That's a great way to put it. There are 2 ironclad rules for this. Rule 1, deposit all receipts intact.
Neat.
Every single dollar that comes in from every source gets deposited directly into the bank that day. It creates an external objective record of your income.
And rule 2 is about payments. Disperse only by check or wire.
Yep. All significant payments should be made through a traceable method. A check, a wire transfer. This leaves a clear audit trail and makes it much harder to, say, pay a fake invoice with a bag of untraceable cash.
The one exception here is the petty cash fund, right? You can't write a check for $8 to buy donuts for the office.
That's the necessary exception. But even that little box of cash has to be controlled. It runs on a voucher system. Every penny spent needs a receipt, and the cash plus the receipts must always add up to the original amount.
So this all comes back to the main idea. Cash is the engine, but it needs this constant systematic vigilance. It's about trusting the process, not just trusting a person.
The system has to check itself constantly.
Which brings us to the final and I think most fascinating point. We set up this system where the company keeps its own careful records, and the bank, this external witness, keeps its records. So in theory, those two numbers should match perfectly.
But they almost never do.
And this is where it gets really interesting for our deep dive. That little difference between what your books say and what the bank says, that's the next clue.
It could be nothing. A check that hasn't cleared yet, a simple bank fee.
Or it could be the tip of a massive fraud iceberg.
And the tool, the indispensable forensic tool you use to solve that mystery, to figure out exactly why those numbers don't line up. That's the bank reconciliation statement. And that's what we'll be tackling in our next deep dive.
Thank you for listening. See you next time.